Every year, ordinary investors hand over billions of euros to fund managers who, 90% of the time, deliver worse results than a simple automated fund that costs almost nothing. That is not bad luck. It is the structure of the system. The investment industry built 4 products. Each one is designed for a different type of investor, and the system is set up so that most people end up in the most expensive tier without ever knowing the others exist. Mike Petry talks about this on Nobody Told Mike, the channel built around the financial philosophy nobody taught us. In episode 1, he explained what an ETF is, but he only showed you one of the 4 tiers the investment industry built. This episode shows the full picture. Nobody Told Mike tells the stories. Here we break down the numbers. Before separating the 4 tiers, it helps to understand what they share. Every fund, ETF, index fund, mutual fund, hedge fund, private equity, works on the same principle. A group of investors pool their money. That pool is invested across a range of assets. Each investor owns a proportional share of the pool. The differences are in 4 variables: who manages the pool, how it is bought and sold, what it invests in, and what it costs. Those 4 variables determine which tier you are in and how much of your return you keep. Chapter 1. Tier 1. ETFs and Index Funds. At the base of the pyramid, the largest tier, built for the most people, sit ETFs and index funds. ETFs, explained simply, both track an index passively. No one decides what to buy. A system follows a list. The S&P 500, the NASDAQ 100, a global market index, and owns everything on it. The difference between index funds versus ETFs is one thing. An index fund is priced once per day after the market closes. An ETF trades throughout the day like an ordinary stock. For a long-term investor, that difference is largely irrelevant. Both are low cost. Expense ratios between 0.03 and 0.20% per year. On a 10,000 euro investment, between 3 and 20 euros annually in fees. Chapter 2. Tier 2. Mutual funds. 1 tier up, mutual funds. Same pooling concept, critically different management. Mutual funds are actively managed. A professional fund manager makes daily buy and sell decisions, trying to beat the market average. That costs money. Typical expense ratio, 0.5 to 1.5% per year. On a 10,000 euro investment, 500 to 1,500 euros annually. Here is the ETF versus mutual funds reality. The SPIVA report, published every year, shows that over 15 years, more than 90% of actively managed mutual funds failed to beat a simple index ETF. 1 tier up, 3 times the cost. Worse results for most investors. Most of the time, if the pyramid is making sense, hit like. It helps more people find exactly this kind of breakdown. Chapter 3. Tier 3. Hedge funds. 2 tiers up, hedge funds. And the rules change entirely. Hedge funds are legally restricted to accredited investors, individuals with a net worth above $1 million or an annual income above $200,000. The legal restriction reflects the risk profile. Hedge funds use strategies unavailable to ordinary funds: short selling, leverage, derivatives, complex instruments designed to generate returns in any market direction. The cost model is called 2 and 20, a 2% annual management fee, charged regardless of performance, plus 20% of any profits generated. On a 1 million euro investment generating 10% returns, 20,000 in management fees, plus 20,000 from the profit, 40,000 euros to the fund manager before the investor receives a euro. The potential upside of a hedge fund is real. So is the downside, and the fees are charged either way. Chapter 4. Tier 4. Private equity. At the top of the pyramid sits private equity, the tier most investors never encounter and rarely hear explained. Private equity funds do not invest in publicly traded companies. They acquire private businesses, take them off the market, restructure them, and sell them years later at a profit. The investment horizon is typically 5 to 10 years. The capital is locked in for that entire period. There is no selling early. Minimum investment, typically 250,000 euros or more. Reserved for institutional investors, pension funds, endowments, sovereign wealth funds, and ultra-high net worth individuals. The fee model mirrors hedge funds. 2% management fee annually, 20% of profits on exit, known as carried interest. Private equity returns can be exceptional. They can also be catastrophic, and the capital is committed for a decade regardless. This is not a tier most investors will ever reach. It exists to complete the picture and to show how differently the investment industry treats different levels of capital. 4 tiers, 4 structures, 4 very different costs and access levels. The investment industry did not build this pyramid for your benefit. Each tier exists because it generates revenue, and the higher the tier, the more revenue it generates for the people running it. The entry point to each tier is not arbitrary. It is calibrated. Ordinary investors are directed toward mutual funds, the tier that costs the most and delivers the least for the price. The cheapest, most effective tier sits at the base, open to everyone, largely ignored in mainstream financial advice because it generates almost no fees for advisors. Mike Petry chose Tier 1, ETFs, low cost, passively managed, broadly diversified, not because it was the easiest option, because the evidence, consistently over decades, shows it is the most effective one for the vast majority of investors. That is what Nobody Told Mike is built around. The financial knowledge that changes how you see the system. Here's the question for the comments. Which tier were you in before you watched this? And did you know it? If this breakdown clicked for you, subscribe here for more NTM explainers and watch Mike tell the full story himself. Nobody Told Mike. Episode 1, ETFs Explained, link below.